Teladoc, they reported their latest earnings report. Stock is down 20% on basically extremely weak guidance, not just for next quarter or for the fiscal year, but they also gave us guidance for the next 3 years. All of those metrics missed the analyst consensus, and so we are now down 20.74% at the time of making this video, down to $16.24, meaning we're back under a $3 billion market cap. Which also means that yes, on these metrics here, EV to EBITDA, price to sales in the next 12 months, even price to free cash flow, 12 times next year free cash flow, it's not expensive, but this again shows you that a company can look not expensive, but also be a bad investment. I'll start with a couple of comments here from the CEO. He starts by saying, with approximately 90 million members and thousands of clients around the world, Teladoc Health continues to be the leader in whole person virtual care. During the year, we delivered 33% growth in adjusted EBITDA, as well as free cash flow of $194 million, while driving 8% consolidated top-line growth. At the same time, we brought forward innovative offerings like our integrated app experience and provider-based chronic condition management that differentiates us in the marketplace. We remain focused on serving our clients globally, delivering world-class healthcare, while at the same time expanding our bottom line through a combination of operating leverage and expense reduction. And so if we look at the numbers, revenue increased just 4% year over year for the quarter, or 8% for the whole year. Net loss, still a big one, of course, a major improvement, but that's because of the goodwill impairment charge that they had last year. So that's why you see a huge difference here. Then adjusted EBITDA, an increase of 22% for this quarter to $114.4 million, for the year up $33 million. So that's definitely one of the positive things. It's that the bottom line, let's say, is a bit better. Adjusted EBITDA is better. It's still generating cash each and every quarter. So that's a good thing. The only bad thing here, I would say, is that it feels like it's going nowhere. It's just waiting to be bought up by some other big tech player or some other player in that industry. This is, of course, a very large position for ARK Invest's fund. Remains to be seen what they think about this quarter. Will they double up? Will they cut it loose? Let's wait and see. Of course, if you do still hold Teladoc, do share your opinion down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, if we look at the different segments here, so integrated care, BetterHelp. I mean, for BetterHelp, this has been now the second quarter in a row where revenue has come down. With regards to integrated care segment, yes, it's up, but not by much. That's the thing here. This is not a growth story anymore. It seems like a story of, yes, we might become a bit more profitable, but no growth. Integrated care adjusted EBITDA is down quarter over quarter, up year over year. BetterHelp segment is up big quarter over quarter. Year over year, it's up as well. If you look at the US and international revenue difference here, of course, we know international is still small, growing, but not by much. Same with US. Then, as we continue here, BetterHelp, paying users, not just revenue that is down, but paying user is down yet again quarter over quarter and even year over year. As for integrated care members, that's also down a little bit quarter over quarter, so definitely not such a good sign after we're seeing a continuous growth in that segment. Average revenue per month per US integrated care members is still the same, a bit flat-ish, $1.42 compared to $1.41 last quarter, but down year over year. As for the chronic care program enrollment, that is still going up year over year and quarter over quarter. Then going back to gross margin, adjusted gross margin and EBITDA. Yes, it's true that over the last couple of quarters, if you look at adjusted EBITDA and their margin, that has been going up, and that's probably, I'll remain on the same point, that's probably the main positive points here, is that this has been improving. Yes, gross margin, adjusted gross margin has stayed a bit flat-ish, but okay, I'm not going to be that harsh right now. But this is a good trend. If it can continue like this, that's great. Then overall balance sheet. I mean, cash and cash equivalents, $1.12 billion, convertible and long-term debt on balance sheet, $1.54 billion, operating cash flow for the year, $350 million, and free cash flow for the year, $194 million. So they're definitely safe when it comes to that. I mean, it's a company that is less than $3 billion right now. So they are pretty solid. Then when it comes to guidance, so Q1 guidance and fiscal year 2024 guidance. They expect revenue for next quarter to come in between $630 and $645 million, representing basically a growth of 1.5% at the midpoint, missing the expectations there. Net loss per share of 50 cents, adjusted EBITDA between $52 to $62 million, US integrated care members at around 90 million, so year-over-year growth of 5 to 7%, but not really growing quarter over quarter at all. For the year, they expect that to be around 1.5% growth year over year, adjusted EBITDA to grow, well, there's still a big range here between 7 to 19% year over year, net loss per share around $8, and then revenue as a whole around 2.53% at the midpoint growth year over year. Really not much, especially not when you're thinking about an investment and looking for growth. It's not really giving you much here. They did expand a little bit here with regards to where the growth or non-growth will come from. So integrated care revenue growth around 6% year over year at the midpoint, adjusted EBITDA margin of around 11.5%. BetterHelp revenue growth is actually, it's going to go down between 6 to 3%, and adjusted EBITDA margin of around 6%. So remember, BetterHelp was supposed to be a very, very good growth driver for them. Not anymore. Because even for the full year, we're seeing BetterHelp revenue growth flat to low single digits, adjusted EBITDA margin expansion of flat to approximately 50 basis points. But you're going to get a bit more margin expansion when it comes to integrated care. They're around 150 to 250 basis points for the full year of 2024. So that's what you get right now when you're buying Teladoc. It's true, it's not cheap anymore, but it's cheap for a reason. It's cheap because clearly it doesn't really grow. It's still losing money. Yes, free cash flow positive. That's great. But I do think there are still way better opportunities right now in the market. Now, they did give us something they never gave before, or barely gave before. It's now a 3-year outlook. So they expect low to mid-single digit annual consolidated revenue growth, including mid-single digit in integrated care and low single digit BetterHelp annual revenue growth, basically what we're seeing right now. And 50 to 100 basis points of annual margin expansion and at least $425 million of adjusted EBITDA for the full year of 2025. And that's inclusive of cost actions associated with their efficiency program, which they explain right here. So, okay, again, if you're playing this as we might be near a bottom, we might see an upside for, I don't know, a year or two because, well, there's margin expansion, adjusted EBITDA goes up, market cap under $3 billion. I still think maybe there's a chance of this being acquired. Then yes, maybe this might be a play. Maybe you can play it with options. It's always an option. But right now, I don't really think the market appreciates investments like this, and rightfully so. Then if we look at the graph right now, this is on the daily, we're going to be very close to where we were back in November of 2023 and October of 2023, which was the bottom at around $15, $16 or so. And yes, if I zoom in a little bit, it's true, this was a small gap that might actually be filled a couple of months later. So yeah, I mean, it's going to be looking very cheap on a graph. It's going to be very interesting to see if it can hold what was previously a support line. Let's see. I'm very interested to see if ARK has changed their tone when it comes to that investment. Of course, it's one of those investments that has not worked out at all for them, as with many other pandemic darlings. But let's see. Do you think this is a good investment at $16 right now? Yes, no, let me know down in the comments below. My opinion is pretty clear. I'll stay far away from Teladoc right now, even though I do still think that maybe they'll get acquired and so you get that premium, but that's just a trade play here. But do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.